And we are live. Welcome, everybody. It's webinar time. It's especially masterclass time. I'm very pleased today with today's topic. I'm very pleased to have TreasurySpring here, Benjamin and Felix as well. We're going to talk money market funds. We're going to talk fixed term funds. Treasury's masterclass. Why a masterclass? Because we're also going to explain differences. We're going to explain what they do, what they are used for, and how you can use them. Use this webinar. You're very welcome to ask questions. Let's make this as interactive as possible. You have the option to put your comments in the chat, put your questions in the chat. Some of you already sending questions up front. We incorporated them already in the questions to my panel. If you feel like you want to repeat your question, please do. Please ask these guys all the questions you have. This is your opportunity to pull them on their knowledge and get as much out of it as possible. Before we start, let me introduce my panel. We have Benjamin, Treasury Masterminds board member, one of the first board members on board. Very happy to have him participating in this webinar. And as a Masterminds board member, welcome, Benjamin. We have Felix, the treasurer of JetBrains, and we have Nigel, the capital markets expert from TreasurySpring. He will be our product owner, knowledgeable about fixed term funds. So without further ado, let's start with the masterclass. Benjamin, let me start with you. Let's start with the basics. Let's start with money market funds. How do they work? And why should treasurers be looking at them?
Yeah, so thank you, Patrick, and really glad to be here and honored as well. Let's deep dive into the topic. So money market funds, I want just to maybe spend 5 minutes to depict all the goods from money market funds first. And I'm a firm believer of money market funds, but also maybe 2 minutes after this to drill down into what are the risks, sometimes hidden, that I've realized myself using money market funds, and why I'm myself exploring other alternatives to complement them, like fixed-term funds. So money market funds, like really basically are a commingled pool of money market securities. So you can have commercial papers, you can have bank obligation, government paper, also repos or purchase agreements that are typically established and managed by a financial institution and an asset manager. When you invest in a fund, so you as an investor, there's some background noise.
Go ahead.
Yeah. So when you're a corporate treasurer, you act as an investor and you will purchase an ownership interest or share in the fund. So why I'm still a firm believer of money market funds and why they remain popular, I would say 4 or 5 main items. First of all, and the most important one for treasurers, is the liquidity. So money market funds offer daily redemptions. So it makes money market funds as liquid as an overnight deposit. You have also, very important, is the capital preservation. So we have the diversification here of the risk. So money market funds will pool assets across issuers, jurisdictions, instruments. So you sort of reduce your concentration risk, unlike what you would have on a term deposit, for example. And there's relative security of principal. So it's not zero risk. No investment is like this. But you have a security of principal still. So you have stable and secure investment historically. We have seen it during periods of interest rates volatility in recent years. So for example, if interest rates are falling on the market, what money market funds managers will do, they will extend the maturities of new securities, also the underlying assets, and they will do this to lock in yield so that you benefit from a yield that is higher than what you would get or slightly higher to what you have on the market. But it's nice, but it also brings its set of additional liquidity risk for us as treasurers, and I will come to that right after. And of course, the opposite holds true in rising interest rates in that fashion. So money market funds will really adjust the maturity of the underlying investment based on the interest rates on the market. A third element will be the stability. We have seen it has been proven resilience during market stress. But it comes to my fourth point, is the regulation. The money market fund had to be strongly regulated. Like we all remember the 2007, 8, and 9 global financial crisis. And for those who have seen also what happened on money market funds at that time, we had one of the largest money market funds to break the buck. So it means the fund net asset value, NAV, dropped by below $1 per share. And why it occurred is because the fund's various underlying securities dropped in value. And so the fund ran short of cash because there were excess redemptions requests, meaning all investors were calling their cash back. But because of this event and others, money market funds are now highly regulated. They have strict liquidity and credit quality rules. You have different regulators. You have ISMA in Europe. You have SEC in the US. And so those regulations really focus on key features. For example, what is permitted in terms of investments and certain diversification rules. So the money market funds must be holding instruments with certain characteristics, like it's a government securities, instruments that are guaranteed by government, and also a counterparty limit to achieve diversification. And last but not least, on this one, on the regulation, is all the what we call the maximum weighted average maturity. So when we talk about short-term money market funds, they should have a weighted average maturity. So the weighted time on which the underlying investment are maturing should be 60 days, maximum 120 days. Standard money market funds offer a bit more than this. And then there are liquidity requirements. So it's strongly regulated in that as well, meaning we must have assets that are maturing overnight or within a week. And also the fund pricing. So we talk about the floating, variable net asset value, constant NAV, low volatility net asset value. So those are a bit more detailed. But overall, gladly, the regulations imposed minimum liquidity requirements with daily and weekly requirements. But there's also a restriction for funds to purchase illiquid or lower quality securities. And another thing is it brings the ability for the fund to suspend redemptions for a period of up to 10 days in some cases. So it brings also a set of risk for treasurers. I'll come to that after. And the fifth, let's say, reason why I'm still believing in money market funds is the economies of scale, because you have relatively low transaction costs to help ensure yield is not eroded by the active management of underlying portfolios. So overall, they're still key resource for treasurers. They provide short-term investment. They are highly liquid, ready access to fund when needed. You have a broad range of diversified security. It's relatively low cost for an organization. It's professionally managed and also easy to use. So helping free up treasury resources for other tasks. But it's an investment. So in an investment, you have a risk of loss. And here it is mitigated by the diversification they offer, the regulation, etc. So now I come to why I'm firm a believer, but still thinking about an alternative. Is because, yeah, they are popular for what I just mentioned, but there are different factors. I would say 3 or 4 main that I've seen that prompt me, and I hope also other treasurers, to reassess the role of money market funds. First of all is the interest rate volatility. We've seen in the past month and years all the central banks entering into rate cutting cycles, and the yields on money market funds have been declining. And we as treasurers, we seek alternative. We don't want to have cash sitting on our account, or money market funds that are not giving the yield that we expect. And so we're seeking alternative to have better returns without sacrificing safety. That's really key. And so because of this, money market funds want, of course, to attract us. And so they will extend the maturity of their investment, but it brings some liquidity risk for treasurers. Like if you want to redeem your investment in a stress market, the history will tell you that it has already happened that some lines on the money market funds were broken and not available. Then the second element is the credit risk awareness. So yes, we have the diversification, but we've seen also the bank failures reminding us of the importance of a rigorous credit process and review. And with money market funds, I must admit that it's not always straightforward to have the full and accurate visibility on the investments, on the geographies, on all those securities. So you have a list usually, but it's difficult to get really to the bottom of it and understand your credit exposure. A third element is a yield curve dynamic. As I said, money market funds are very sensitive to short-term yield curve shifts with the central bank's move we've seen in the past. So it's a bit less predictable when you have an environment that is a bit more volatile. And the last one is the accounting treatment. So for those are using IFRS, no problem. They are considered as cash and cash equivalent. But I'm here sitting in Luxembourg, and we have an issue with Lux Gap, for example, local gap where the money market fund's interest may not qualify as cash and cash equivalent. So it's a bit discouraging the use of liquidity, discouraging their use for tax reasons. So that's why treasurers are looking to benefit from additional protection offered by secured investments to mitigate risk and consider return on more risk-adjusted basis. And that's where FTF can provide, in my view, really a significantly better risk-adjusted return than if you compare it to unsecured options, because the underlying investments are backed by a collateral. And I will let Felix explain this in the next question.
Yeah, makes sense. So to summarize a bit, Benjamin, you're saying one MMF is not the other MMF. You still have to compare them on duration, on counterparty risk, on asset class, and definitely on type. You should investigate your accounting treatment. And German GAAP, by the way, also doesn't see it as an investment, not as a...
Yeah, there's an ambiguity, and that's the problem. Yeah. Mm-hmm.
Exactly. But you should compare it with your bank deposit as well. Your bank deposit is also not risk-free. There's also duration involved if you do deposits and time commitments there. So I think do your research. That's definitely what I'm saying. But there are alternatives, and we're going to talk about them as well. Felix, what cash instruments are you using, and why did you like them, or why, and what are the risks involved with them compared to money market funds?
Thank you, Patrick, and hello, everyone. Nice to be here on this masterclass. We are not a financial institution, and the main business of our company is software development. Therefore, the core treasury task is to maintain the sustainable liquidity position and ensure that we have enough liquidity in the right time, in the right currency, in the right bank account. Therefore, we don't go into risky investment strategies, and we use conservative strategy to manage our liquidity with mainly money market instruments in short term and fixed income instruments in midterm. Therefore, for money markets, we use obviously bank deposits, we use money market funds, we use FTFs, and for longer term investments, we use bonds and some structured products of the same fixed income nature. And of course, each of these instruments has its benefits, its advantages. Benjamin was very nice describing most of the advantages and disadvantages of MMFs. Deposits, obviously, they allow us just to keep the money within the banks that we operate, and but of course this is the lowest of achievable interest in comparison to the premiums that MMFs and FTFs offer. But deposits, when you have an ability to freeze funds for some period of time, it's still better than the account interest that the banks are offering. So this is a kind of an revenue ladder where you have a bank account interest accruals on the lower stage, and then you have deposits, then you have MMFs, and then you have FTFs, and then you have bonds, which is also riding the yield curve. Hopefully, it starts to normalize at this stage when we have longer maturities delivering higher yields than the shorter maturities. And while balancing between all these instruments, we also try to use some common sense and balance between the administrative bureaucracy that requires processing each and every trade, and also the benefits that moving the money between different instruments brings us.
Thanks, makes sense. What made you decide to go to FTFs compared to the banks?
Main reasons is that FTFs, first of all, they offer a higher yield and higher revenues at the relatively same level of risk. We can say that money market funds, they, as Benjamin also described, it's T plus zero, so it's cash and cash equivalent. It's mainly alternative to keeping the money on the account, and on the very short tenors, FTFs and money market funds, they offer relatively the same yields, while MMFs do have that fund run risk, which is very low probability, but it still exists. At the same time, with FTF structure, it is a single obligor, single borrower that you may choose. So you're accepting a credit risk of a certain obligor, and you can decide yourself which level of risk is acceptable for you and your company. That can be a sovereign risk, that can be a corporate risk. There are different levels of that, but you don't have that fund run risk. Then it's about maturities and it's about liquidity forecasting. We in our company have quite efficient liquidity forecasting. We know when to expect large payments, and therefore we can match the maturities and we can freeze funds for longer. And that's where FTFs, they close the gap between MMFs with T plus zero and between bonds, which are better to invest for 1 year and longer, because as a corporate client, without direct access to the financial market, of course, we pay fees for every trade on a fixed income market. And even though you can bargain really nice fees, you still have to pay them. And that makes no sense on short-term bonds and maturity and their revenues. Therefore, you can really have investments in FTFs on the tenor of up to 1 year, receiving the benefits of the yield curve and without additional fees. And the third thing is, of course, diversification. It is important that we diversify in different instruments. We balance our exposures. And one more thing about FTFs. So it's actually gives you access to the institutional pricing on the deposit market.
And if I may add something on this, is whether money market funds or FTF, I think it's important to stress to have a more active management of liquidity and optimizing the liquidity, having better returns, and not just like letting cash, basic things, but just don't let your just cash sitting on current accounts and negotiate those conditions with your banks. Nice if you have a few basis points here and there, but look at the opportunity cost. Don't only look at what you're getting, but also what you could get. And so that one thing, just a bit more active management. Meaning, if you think about now, okay, let's go with term deposits, for example, with a bank. Well, think about two things here with alternative like MMF or FTF, is the counterparty risk. I mean, you're exposed to a bank, it's unsecured for most of the time. So you just send your cash there, and then that's it. And then you have a weekly deposit, monthly deposit, or the like. But think about also if you think, there is no cost in doing term deposit because there is no fee. There's a fee on money market funds, FTF. Or think about the internal cost, because most of the time it's going to be fully manual, fully email-based, no visibility, no reports. Banks are not all equal there. So there's a big element, operational risk of missing the maturity, or you have extended, you should not have extended. So there's a big cost there as well, counterparty risk, but also the operational cost, and there's no advanced technology to do term deposits, and the internal mindset sometimes of your stakeholders internally. there is no liquidity risk. I can always break the deposit. It's not the case, right? So you just see that term deposit don't address always the internal need for daily liquidity and operational efficiency.
And it often made sense because it was so accessible. It happened to be at the bank I'm using, and that's what they offered. It was the quick solution, but you're saying not always the best solution. It can be part of the mix. I hear Felix say we use it partly. It's also not either or on money market funds and FTFs. It can be a bit of both. It depends on your strategy investments, and of course how your ability to forecast and the period you are confident that you do not need the cash, and then your investment horizons. Interesting insight, guys. Nigel, now let's hear it from you. We've used the term FTF quite a while now. We heard the use cases, but now let's hear it from you from a vendor perspective. What's your definition? How would you explain to a client prospect I've never heard about an FTF? What is an FTF and how does it work?
Yeah, good morning, everybody. Thank you, Treasury Masterminds, for having us on this masterclass. So an FTF stands for Fixed Term Fund. And the original aim for this basically was to bring capital markets products to those who didn't really have access to capital markets products. And the guys on the line today are attested to that. In terms of a structure, basically it's delivered in a fund format. So that's one difference to what we've been talking about so far. And essentially it's a wrapper around a single short-dated fixed income instrument. So the treasurer will choose the single name they wish to have exposure to from the 90 plus that we've got on our platform at the moment. As mentioned, that can be govies, that can be SSAs, it can be financials in both secured and unsecured format, as well as corporates. So you choose the obligor you want exposure to, you choose the maturity that you want, anything from a week out to 12 months currently available on the platform. And the FTF to buy, the fund that you buy matches that with a fund that only you own. It's got the same risk, the same volatility as what you've chosen there. So what you've got is you've got no credit commingling risk as you have in the MMFs. You've got no maturity transformation taking place. It's a straight pass-through exposure. You've got no run risk. As Benjamin mentioned there, the regulation means that there is the potential from time to time that the cash might be gated in an MMF. But in this, it's as long as the underlying borrower repays on their security, you will get repaid in terms of your FTF. And there's no mark-to-market volatility in there as well. So very different from money market funds, quite different from term deposits as well. With the added advantage, the delivery method means that with one onboarding, you can diversify your cash investments on one platform in one go, rather than having to onboard with several different institutions and then having to deal with several different banks, ring around, get different rates through the morning. It's all there in one place for you to be easily able to compare. And particularly so if you're looking at the secured side, if anybody on the line has ever tried to tackle the documentation involved in trading reverse repo with just one bank, it's a significant work in terms of the documentation there. A secured FTF takes away all that work and offers access via the platform to multiple institutions in that format now in multiple different jurisdictions. So you can still place your cash with your house bank, which is sometimes a worry for people. You can actually get it in secured format, and you can still spread it around a number of banks to diversify that single name risk that is often single name exposure that is often a worry for treasurers.
Yeah. If I can add something there, like it's very good comment what you mentioned, Miguel, on the fact you can still have it with your bank, because money market funds is moving cash away from the bank and can also alter the relationship sometimes. So it's also important to see that you see it holistically with the bank relationship, where you use the deposits. If you use money market funds, you're gonna move away from the bank completely. Where FTF can be exposed with a bank, and you can still have that including the overall bank relationship. That's another advantage.
Yes, no, definitely, and I think the banks like the fact that you come in via a TreasurySpring, because TreasurySpring is the aggregator dealing with you directly for maybe 20 million, maybe 50 million, I don't know. they can deal directly with TreasurySpring and get 500 million in via the fixed term fund. And I have a question on that, Nigel. It means I'm doing a fund. I have 90 counterparties, but I'm dealing with you as a platform provider, and also there's one fund. So it means if I do a deposit for a week with bank one, and in week two I want to decide I'm not going to roll over with this bank, I'm going to give it to another bank for risk reasons, for rate reasons, whatever. It doesn't mean I have to get my money back and send it to the other bank. It probably stays within the fund and you just allocate it differently. That's how it works, right?
Correct. We actually technically do create a different fund for each different trade. It's one of the way that the structures work. But yes, you wouldn't need to take the money back into your account and pay it out another way. Just ahead of the maturity of your first investment, you would then notify us that you wish to switch it into a different bank at that time. We would then administer those movements of funds for you. Again, taking a step of process out of your day, making your life easier there. You would then receive notification that your money has then been invested in that new fund with the different bank for the following week, month, whatever the maturity is that you wanted to invest your cash for.
Yeah, makes sense.
Let me jump. Sorry, Patrick. Let me jump into your previous question. You mentioned investment through TreasurySpring to your bank with 20 or 50 million. It can even work for some banks starting from 1 or 2.5 million, which is a quite tiny amount, but still, because it works through TreasurySpring. Through FTFs, it works with an institutional and capital markets desk, and not your usual corporate relationship manager and treasury sales desk of the bank, which offers usually offers lower deposit rates than the institutional desk, and that allows you to get better quotes, better rates on even on your small amounts. And the second thing about reshuffling your investment, that's really one of the benefits of TreasurySpring that I like as a user, that if you want to switch between different funds, you don't have to send money again back and forth, and you can automatically choose a different fund in the platform, different investment, and it will be processed directly. And you even have the flexibility to change the investment size, investment amount, investment size. You can withdraw interest or reinvest interest, and the platforms offers really nice capabilities for that.
Just to clarify, if anybody was worried about, they don't know who TreasurySpring are and what our credit exposure is, within the process, the way it's set up, there is no risk, there is no credit risk exposure to or from TreasurySpring within that. All the funds are handled by a fund administrator, R&H, who looks after that. So hopefully not, but even if TreasurySpring didn't exist at the end of the trade, as it did at the start, they would still administer the final cash flows. So as long as the underlying has paid its cash back, you will get that back and go from there. I see we've had a question around onboarding. Onboarding with TreasurySpring, is, we like to think that we've made it as efficient as we can do. It is still a thorough process. We do go through full due diligence and onboarding process there, but it is done through the platform. We like to think we've got it down to a good art now that we can get it done in a number of days, the most straightforward onboardings from there. So feel free. I'm sure you'll find us on the internet, come through our webpage, chat to us, and the guys will run you through the full process there, but we do try to make it as smooth as possible.
Yeah, but clients would KYC with you. You do the KYC, you do the onboarding. I don't have to KYC with the 90 banks or counterparties. If you KYC'd me, I have access to all the 90 or all the counterparties you have.
Absolutely, that's it. One KYC, one due diligence, and then you're onto the platform from there. There is the choice is there. Everything on there is rated at least single A or better, just to let people know it in that format. So it is around, obviously, capital preservation to start with, but from there, then we are looking, as Benjamin said, to offer people competitive risk-adjusted returns, not necessarily just the best rate out there. We're taking into account the risk that we are offering to people in placing their cash with the various institutions in the different types that we've talked about.
And for risk, you use official ratings of the counterparties.
Yeah, that's it. I mean, we publish the ratings from S&P and Moody's on our website of the underlyings that you are investing in, so you can see that there. We also work with a company called Credit Benchmark as well, who are an aggregator of banks' internal credit ratings, and we provide a little bit of comparison there, a different way to look at ratings, just if people want to look at something different to the usual rating agency models as well.
Yeah, right, makes sense. I heard terms about run risk, market to market. Benjamin, that's something we need to explain. Not everybody might be familiar with these terms. Let's start with run risk in money market funds. What does it really mean?
Yep. So I've mentioned the run risk and also break the buck earlier. So there are related concepts in the context of money market funds, but they are not exactly the same thing. So the run risk is the risk of large-scale investors redemptions for money market funds in a short period, and that we've seen in the past, and it often triggered by a fear of breaking the buck or market stress, basically. So if you're investing in money market funds and then you suddenly see that you have a market stress, and then the money market fund provider will going to start to extend their maturities, and then you see they will extend maturity to protect the yield, but then you see market distress, so you want to redeem, and so that's all at once. Everybody is running their cash or redeeming their cash at the same time. So runs can force funds to sell assets quickly at depressed prices, and it will worsen the liquidity, and it will cause the net asset value to fall further. And that's why we had regulatory reforms with the floating NAV, liquidity fees, redemption gates after the 2008 financial crisis. But that also means that there is a risk of this run risk, even though it's regulated. For example, the redemption gate means you cannot get your cash as quickly as you want, to ensure that that the money market funds provider don't run out of cash because they have extended their underlying investment maturity. And that's the distortion, I would say, with money market funds is they propose a daily liquidity, but the underlying assets are not all liquid. So it's really a bet that we don't all go at once and redeem our cash.
Yeah. Okay, makes sense. And I also, Nigel, I heard about market to markets. I don't think fixed income funds do have market to market, but how about the accounting perspective with this maturity matching? Is it cash and cash equivalent? Does market to market volatility is even an issue with fixed income funds?
With the fixed term fund, because you're getting the fixed interest rate back, and you know what that is on day one when you put that cash in there, you know exactly what your cash is for. It gives you that forecasting ability to know what you're going to get back, as opposed to money market funds where the rate is fixed on a daily basis. As we said, the shape of the yield curve dictates that a little bit in terms of money market funds, but in terms of fixed term funds, because you know exactly upfront what returns you're going to get on what date, it makes your whole accounting process and forecasting much easier.
And if I may, you've never seen any local gap ambiguity in that regard on cash and cash equivalent?
I will plead the fifth here and say that we're not here to give tax and accounting advice, but as far as we're concerned, we're open and transparent with our clients, and obviously if we can help on that front, then we can do. But we believe it should be accounted for as cash and cash equivalents.
Yeah. Okay. And what happens if I make a mistake? I deposit for a month because I'm very confident in my cash flow forecast, but then something weird happens, and after 2 weeks, I need my money back. Are there charges? There's an audience question there. Can I break the deposit? Are there penalties?
Yeah, the FTF currently is very much sold as a buy to hold investment. So that is the expectation there. There's no, we don't have a secondary market in the moment. We'd like to, the bigger, and as with any market, the bigger and more liquid it gets, the more opportunity there may be to provide secondary liquidity on that. So it's not something that we offer in terms of breaking it. There are often reasons why people may need to want to break them, but we can't guarantee any sort of price or buyback option on them at the moment.
Yeah. Okay. Interesting. I see there's an audience question on the KYC. That's an interesting one, and maybe Felix, you should take that one. Is the reference to KYC in the context of FTFs not confusing? FTFs not deposits where the banks need to KYC you as an investor. No, TreasurySpring does that. Those using FTFs are lending to the banks they select. So this is a fixed term investment with a defined coupon, not a deposit. Is that not correct? Felix or Nigel, can one of you comment? Felix, you went through the KYC. How did you experience it? And
Sure, I'll take this one. AML KYC onboarding is my favorite topic because when I look at how, so many thousands, if not millions of people globally in banks, funds, and everywhere are working on passing the papers to each other, and then regulators also controlling all of that and checking all those papers and creating no added value, but at least they're fighting the unemployment rate successfully across the globe. But however, I can say nothing bad about TreasurySpring onboarding. It was not worse than the others. So it's a usual diligent check of documents, of the company structure, of UBOs, potential sanctions. So the usual stuff that companies have to go through during the KYC and onboarding to other MMF platforms, to the banks. So it's a quite standard process and definitely not worse than the others.
Yeah, makes sense. Makes sense. I see another audience question. I think that's for you, Nigel. What are the advantages of an FTF over fixed income ETF, exchange traded funds?
In terms of it, we're talking about the fact that it's single name exposure, and in the ETF, you're not always, a bit like Benjamin said, when you're trying to get the details of what's in the underlying of an MMF, equally so in the ETF, trying to keep track of what's in the fund, what's traded in and out of, on a day-to-day basis for a treasurer who has myriad of other things to do in your day, it's quite a difficult thing to keep track of. So that's the obvious difference for starters. In an ETF, you're going to have that mark-to-market valuation and volatility as well, depending on the underlying valuation. So yeah, very different products. And again, depending around what do you want out of it in terms of security of capital, in terms of the secured investment, and going from there. One other question that's come in there on how to convince the wider internal finance community. One of the things that we always see added interest is when there are problems around banks. If there are people who doubt that you need viable alternative to banks, refer them to have a look at Credit Suisse, at SVB Bank, at Lehman's, and that's just in the last 20 years, a number that just roll off there. Banks are not necessarily as safe as people think they are. Therefore, they should be the risk should be considered, and diversifying your cash holdings away from just one or two banks is definitely something that people should consider. And then ultimately, we come back to risk-adjusted returns. What returns are you getting for the risk that your investment criteria allow you to make?
If I can add on this, on the how to convince internally, because you can have a hard time convincing even money market funds. It's not so well known everywhere. FTF or money market funds is really to do a subset. Like you don't go all in with one product. So you propose to expand, diversify the pool of investments. Just to a bit reassure the audience and the C-suite, if you have to convince your C-suite, is we're not going all in FTF, we're not going all in money market funds, all in term deposit, whatever. We want to diversify and then maybe improve your forecast before you do this, so you can know which product fits you best. But I would do it like this. I feel reassured that we're not going all in. Our cash is still going to be preserved with the advantages of a bank deposit, because that's the most well known by let's say the C-suite. Yeah, bank deposit, I know what it is, but you start by mentioning, okay, what about the risk of the bank, as Nico mentioned, bank do go bust, and they still do. And every now and then we have a small or big bank that is going bust. So it does happen. So we want to mitigate that risk. You have money market funds that are better for this, FTF are better for that, and we propose to diversify and use all those products together. I think I will give them reassurance that they're not putting all their eggs in the same basket, and then little by little they gain confidence on the product. You have delivered, you have proven that it works, that operationally also it's efficient, and then you can then have a strategy to go more towards the FTF or money market funds. So I would do it like this.
Yeah, and
sorry, Patrick, if I can add a little bit more to comparison of FTFs to fixed income ETFs. That's a nice question. I really like that. And putting it very simple is that FTF by economic sense is similar to bank deposit, where you have a fixed maturity and where you have the known yield that you expect to receive at the maturity. While ETF, it's actually a stock, which is traded on the exchange, and it's impacted by the underlying fixed income of this ETF, which is being reinvested and reevaluated market to market. So if the market environment changes and the underlying bonds of this ETF fall in their prices, that will also decrease the price of the ETFs. When you decide to exit, you have a risk of capital loss on this investment. While in FTF, you only have a credit risk if the obligor does not repay your deposit, your FTF. That's the core and the key difference, I guess.
Yeah, that makes sense.
So the one other difference that is important as well is in ETFs, you're likely to be paying a fee, an ongoing fee for holding the ETF. With the FTF, there are no fees. The level that you see is the level that you get. It's like a term deposit on that basis. You will know upfront that this is the rate you're going to get, this is the return you're going to get. To clarify, there are no fees to be on the TreasurySpring platform. It is literally you register your KYC, you choose to invest as and when you want to. And say there are no fees or ongoing fees at all with FTFs.
Yeah. Makes sense. I want to continue, Benjamin or Felix, on this risk. I have a bit of a feeling that risk is more important than return. Of course, return is also important, but it's all about diversification. Not everything in one basket. Counterparty risk. There are FTFs out there which are also repo, asset-backed and fully secured. But obviously, security brings down the rate a bit. How do you decide between risk, security, and reward? Maximizing the highest rate. That would probably mean going for the lowest rating. But the highest security, AAA repo, probably gives also the lowest return. So how do you balance that mix?
Shall I start? I think that's individual for every company, depending on the risk appetite. So the company internally, depending on its size and whoever is responsible for that decision, be it investment committee, be it CFO, be it treasurer, they decide and agree internally on their risk appetite, and if they go for higher risk, or if they set the risk limits, the exposure limits on different instruments, on different ratings, on their investment strategy, and that's what is individual for different companies.
Yeah, I agree, and it's also something a treasurer should be taking the hands on to propose an investment or a deposit policy to the board. And then as Felix said, that you would mention which type of investments grades your company is willing to adopt, and there is no copy paste. I've done this mistake a few times in my career to consider that the risk philosophy of one company was the same as the other one. So very true. Like I would not jump straight into, if you join a new company, into okay, let's adopt this great discussion ahead on the webinar. Let's understand the risk management philosophy of your company. Then you can draft this policy and propose products. But I think it's for me as a treasurer, is liquidity first, capital preservation first, return comes after. And that's a message that needs to be passed. I mean, if it's not the case, if it's not the policy of your company, it's more, no, we're here to make profit. Treasury is a profit center. Well, maybe it's not the right place or the right role. It depends. But for me, it would be more, okay, we're here to guarantee liquidity. And then return can be achieved if you have, as I said before, a forecast. Do you have data? Okay, do you have the data to make that decisions? Like, do you know across the next week what will your cash position be? If no, then maybe go with daily liquidity to guarantee liquidity. Guarantee liquidity also means you know where you place the money. Is it only with one bank? Yeah, it's a big bank, no worries. Well, yeah, you should worry. So think about an alternative, not only with one bank. So the term, the maturity that you want to get. If you have no visibility, think about daily. If you have a bit more forecast, 1 week, we're not talking about 1 year forecast, but 1 week forecast, that's something to work on. If you don't have that, then you can think about better yield, because you will have the longer maturity, the higher yield you will get. So I would just go with getting the data right, and then you adjust your product based on that. So your forecast, maybe use some deposits, a bit of FTF here and there. Money market funds could be better suited for really the daily liquidity. So yeah, but think about liquidity and capital preservation first.
Makes sense. And secured, Nigel, what does secured then mean? Is it 100% safe, asset backing?
Yeah, we've been talking about capital preservation and liquidity in there as well. What we get when it comes in terms of secured is you get reverse repo. So to explain that for people who don't fully understand that process, that means that when you place your cash, there is an equivalent amount of collateral with a suitable haircut, i.e. an over collateralization of a security basket with a third party who manages that collateral on your behalf. So should there happen to be a credit event, which means that the underlying bank that you have placed your cash with is not able to repay your cash in full or in part on the redemption date, you or we on the investment side will take ownership of that collateral, which immediately means, and that's immediate, so that's not a process you have to go through for weeks and months as you would do in the unsecured. In the secured, you take immediate delivery of that collateral basket, which can then be traded in the market to raise the funds. So you have that added security of getting your liquidity back on day one in the market. Equally so, you can choose which collateral basket you want. If you want to be at the ultra secure end of it, you can specify that it's only going to be in governments or in SSAs at the AAA rated end of it, or there can be a broader basket, but you're still getting over collateralization in there, haircuts that are applicable to the underlying securities, so that should there be a shortfall, you'll do that. And the added, the extra belt and braces on top of that is, even if there is still a shortfall between the collateral sale price and the value of your investment, the remaining portion of that, however small, then becomes an unsecured claim as well. So you're still in the basket with everybody else for an unsecured claim, the remaining amount, even if you've been paid 99% of your investment in the secured element. So yes, that's where the security comes in. Is it 100% secure? No, absolutely not. There is a risk of a shortfall, but you still have a claim as an unsecured creditor against everybody else who was invested with that bank as an unsecured creditor.
Mm-hmm. Yeah, you have the front row seat instead of the being in the whole room. Yeah, that makes sense.
And that unsecured element can take a long time. That can be a long process before people get their money back. So the importance is not just the fact that you are at the front of the queue, it's the front of the queue and it pays out on day one. So again, it comes back to Ben's point. You're getting that certainty of liquidity around your forecasting, that protection of capital that, yes, in unsecured, you may get your money back at some point in time, but it brings uncertainty in your forecasting.
No, I agree with Lehman into gears for some counterparties, and I think some are still trying to chase. We're a bit over time. I have a final question for all three of you. Keep it short. We have audience here listening to your advice. Some of them might want to start or need to start now. What's your one advice in 1 or 2 sentences? I want to start investing. where to start, where to look at. Benjamin, let's start with you.
Yeah, well, very short. So we should all have FTF or MMF or whatever as part of a broader portfolio strategy, and I think we should divide cash into buckets based on the liquidity needs, and you invest accordingly. You select high yield or high quality issuers, short duration or longer duration based on the data that you have. Ensure you have also automation and visibility, which can be offered with platforms. You have money market funds platform, you have FTF platform with TreasurySpring, which give you this automation, the reporting as well, and the ease to execute and have a seamless operation for your investment strategy, unlike the old-fashioned term deposit that you do per email.
Yeah. Okay. Felix?
The treasurers mainly think the same, so I can only confirm that diversification is the key, and you have to have all different investment tools in your portfolio. But what I would like to add about specifically TreasurySpring is what my personal user experience is, that I really like their platform, which is very simple and intuitive, and really has a very good visualization of portfolios, access to different features. That was really a very nice experience, which really exceeded my expectations. And what I also would like to add, that working with FTFs, with my team, we have come up with different ideas on how to improve different things, and TreasurySpring was always very responsive, like taking these ideas into work, and some of them were implemented, and I hope that other users of TreasurySpring also benefited from that. But I really like that level of communication and responsiveness to customer feedback.
Nice. Yeah.
The two guys there for the endorsement, right? I can't put it any better myself. I think Felix made a good point there. You need to have a toolkit as a treasurer, and TreasurySpring, we feel, should be part of that toolkit. We're not saying we're going to replace your bank relationships or your MMFs or anything like that. It should just be one of the tools that you have in your toolkit. And as I mentioned there's no cost to being on the platform. So actually go away from this call, have a look at the TreasurySpring website, the platform, contact the sales guys, have a chat, have a run through of how it works, and have a look, and then get yourself signed up. There's no fee for being on there. There's no obligation to use it, but it gives you the option once you're signed up to use it should you wish to. It might be that you're coming towards the end of the year, when I know there can be a tricky time when banks don't necessarily want money on their balance sheets as often as they do. What we've managed to do on TreasurySpring is to get a range of banks in there that have different year ends. So the Canadian banks, for example, have year ends at the end of October, meaning that we have different options in there. So there should be some more competitive rates going into year end and things like that. So give yourself the options, broaden out that toolkit, add TreasurySpring to it, and look at the different options we have on there. Just answer the one question that came in about TreasurySpring there at the end in terms of UK. The funds are Jersey based, so they are regulated by the Jersey regulator, which ranks pari passu with the FCA in the UK. So they are Jersey based, but do have that regulation that is of similar levels comparable to the UK.
Yes, amazing. Thanks, guys. This was really insightful. I even learned a few new things here. Amazing. I hope the audience did as well. I think we skipped one or two audience questions. Addressing the audience, feel free to contact Benjamin, Felix, or Nigel directly. They're all very open to connect and talk to you. They're also quite nice guys as well. Also Nigel and the TreasurySpring team, I know them as very responsive, very open to discussion. So if you have those detailed questions, check with them on the tax and accounting, your IFRS. Ask them the difficult question. Reach out to them after this masterclass and go from there. And I wish you all a nice day. Thanks, guys, for being here and sharing your knowledge and being part of this masterclass. Thanks, audience, for joining. And on to the next webinars and masterclasses in a few weeks. So thank you and have a nice day.
Thank you, everyone.
Thank you.